and foremost, yes, this is my puppy on my shoulder. If you don't know, his name is Jimbo. He's an older puppy, he's 15 and a half, and he's a little fidgety and fussy. So I'm going to try to hold him, see if we can't keep him quiet while we do this daily financial news. A couple of quick things to point out. First, we got 3 interviews today, one at 8 with our expert Anna Kelly. At 9, we'll be interviewing a Southern California real estate agent talking about the SoCal market. And then at 10, we're going to be talking with another expert, mortgage Matt, the mortgage guy, really talking about what is going on with interest rates because he's been texting me. And yes, folks, the 30-year rate is going up. So we're going to talk about all of that today. Be warned, a lot of content is coming. I apologize if it is too much for you. I do my best to highlight the title about what is exactly in the video. So if you like the title, great. If it doesn't meet your needs, great. But please don't be annoyed by the amount of content produced. Give me a thumbs up, hit that subscribe button. We are trying to create content for you, not try to trick or fool the YouTube algorithm. Next up, if you're one of my students, or frankly, if you're interested in real estate investing, I put out a homework assignment yesterday that I think is very important for 2021. In 2020, it was really hard to be a buy and hold real estate investor. You had to work really hard because there was no supply, and anything of even medium quality would get bids above what they are worth because owner occupants can frankly pay more. I think that changes in 2021. I think rising rates causes some owners to back off. I think what we will have is some frustrated landlords give up with these eviction moratoriums and CDC orders and all this other nonsense. I think there's going to be the move-up buyer, so quality differences coming. I think it's an exciting year to be a real estate investor, but you have to do your homework. And the homework from yesterday is, what if you understood seller financing? Could you overpay? Could you control the down payment, the interest rate? It actually produce a higher yield by paying more. It's an interesting mental exercise. My students will understand what it's talking about because it's step 1 of the course. But all of you should understand, you know what? You really can overpay if you can control the down payment interest rate and have a higher yield than maybe a standard 20% down deal. Next up, I really want to put this out there early. I see inflation coming, but inflation can come in lots of forms. For me, and this goes back to why I started following the consumer way back in college, and that is I believe the most powerful force is the consumer. And in economic speak, it is called demand pull inflation. That is definitely an economic term, right? Demand pull inflation. What the hell does that mean? Essentially, it means too much money being spent on or chasing too few goods. Think about the fact that roughly 20% of all the dollars ever created in the history of time have been created in the last 12 months, with more to be created. We're not creating more stuff, at least except at the very edges of the margin. Think about what we've heard from builders, lumber, drywall. Now, certainly there are supply reasons. Think about chips in cars. I just heard from yesterday, not only was it Hyundai and Mercedes, but now Ford is slowing production because of chips. Folks, I really do see demand pull inflation as the boogeyman. We will talk about some other variables, why I feel that's an easy call to make. And this is going to be building over time. Demand pull inflation doesn't just come. It builds like a slow boil. But once it's here, it's too late. So just be warned, it's coming. And again, what you'll want to do is you want to own income producing assets, stuff that's protected for inflation, a la cash flow, one rental at a time real estate. So if you have cash in the bank, this is probably going to be an amazing year to do deals, lock in 30-year money, and just let inflation be your friend, both asset inflation and income inflation a la rent for single family homes. So a couple of things I noted for the day after moving on from that is, we'll talk about that later, sorry. Don't know if you saw this, but Target released Q4 numbers, and probably as you would expect, Walmart and Target are going to have really good numbers. Target is the first to release. Sales were up 17.2%. Home goods up 20%. Average transaction up 12.3. That's the price or total value of the transaction. Drive up curbside pickup up 500%. Just big box wins, little mom and pop loses. I mean, this is a tragedy of 2020 reported in early January. Don't know if you saw this. It just came out before I hit go live. DropBox, a tech company here, I believe in San Francisco, has just announced that they are laying off 11% of their global workforce. They had a company-wide objective to hold off on any layoffs through 2020. They can no longer do it. So yes, they are laying off 11% of their employees. I think more of these are coming in some tech companies. It's just where we are in the cycle. On the opposite end of Target, Urban Outfitters, a not big box retailer, a retailer dependent on malls. Well, they had a rough quarter. Holiday sales fell 9%, missed top and bottom, and didn't have very many nice things to say about the next quarter. So again, Urban Outfitter was a miss. And again, I think this is, again, an investable trend. If you're a retailer and you're mall dependent, especially big box mall, kind of anchor store, indoors, rough. I mean, if Q4 was rough, can you imagine what Q1 will be? It's pretty interesting. Next up, KB Homes. This is a real estate channel. We are mainly real estate investors on this channel. Great numbers. They beat top, they beat bottom. Selling price was up 5%. Housing is robust, and they expect it to be robust for the year. Realize that KB Homes is definitely a first-time home buyer builder. That's kind of their focus. They're not Toll Brothers, for example, which focuses on the high end, right? The luxury buyer. KB Homes is definitely first-time home buyer, so you would expect very good numbers. Again, my takeaway there is not only a beat top and bottom, but prices. They were able to raise prices 5%. Ford introduced an increase in China sales for the first time since 2017. I think that's interesting, right? What is it, 4 years later, depending on how you count it? Ford has had a 6% increase in sales of Ford vehicles in China. Again, the first quarterly increase in 3 years, or since 2017. Again, that is interesting. Mortgage rates are up. The average mortgage rates came out for the week. They generally come out on Wednesdays. It was up only a couple of hundred basis points on the margin, but that has already caused purchase applications to go up week on week, 8%, and refis to go up 20% week on week. This is an interesting variable when rates rise, and you can go back and look at this historically. As rates make that turn, it actually pulls forward demand or takes the people off the fence, like, hey, we've been looking, and they've been basically incented to wait because rates were going down. Now they've proved to go up. So we should expect to see, at least for a quarter, kind of that demand pull forward. And it really depends on how fast rates rise. If they do this 100 basis points or maybe even a tenth at a time, it will continue to pull demand forward. But if they race higher, like a full point and a half, real estate will stop, or at least slow down significantly. So we will need to watch that. It is very interesting to watch oil and bank stocks. We've been talking about them a little bit the last 30 days or so. It's the reflation trade. Banks are interesting because I'm going to wait for the first bank, and I'm thinking it's going to be JP Morgan, that reverses that Q2 bad debt reserve. Remember, we talked about that 9 months ago. We thought, or I proposed, that they're over-reserving and doing it on purpose. We're going to see the first bank that goes, you know what? We reserved $7 billion. We're going to take off $1 billion, and boom, falls right to the bottom line. It will be interesting. And then oil stocks. Oil's over 50. I think it's 52 this morning. It might be 51. But that definitely tells you that we are starting to feel better about the future. and going on. One of the reasons I feel very good about demand pull inflation are really three factors. First, saving of disposable income has never been this high in the US. We've talked about this back in April, it might have been May, where we were saving 33% of our disposable income because we didn't know what the hell was going on. That was a 1 month blip, certainly not something that we would hold, but still, as of December, we're still trending above norm. We're saving 13% of our disposable income because we can't go anywhere, right? So we're just plowing it into savings. And again, that is one of the reasons I think demand pull inflation is a layup, because the American consumer on average is a horrible, an atrocious saver. And we are going to come out of this and we are going to go spend on luxury items and trips and all these other things. And we're going to tell ourselves we deserve it and we need it and all this nonsense. We're going to go into consumer debt. It's just an easy call. But again, I think that leads to demand pull inflation. The other two variables that I feel very confident about that makes this demand pull inflation an easy call is it generally comes out when unemployment falls. And again, I think the U3 number is a joke at 6.7. I think the U6 number is like 13.1. It is going to fall. And what that means is more people are going to be employed. Specifically, the easiest variable to talk about is women. We have now lost about 1.2 million women from the workforce. They've made it a conscious decision. They've had to do it for their family, and that will return. And when they do, more income. The other thing, GDP. Folks, if GDP goes up, demand pull inflation goes with it. And we've already talked about it 5 or 6 times. There's a very good chance we spend 12% of our GDP in stimulus in the first half. GDP as called by Goldman. Goldman has now raised their 2021 GDP forecast from 5.6 to 6.4. I think that's low, especially if we get 10% or 12% spending via stimulus and infrastructure and all of that. At the end of the day, CPI is barely moving. It was up 4% mainly on, or 0.4, and 1.4 for the year, mainly on gasoline, right? Gasoline went from sub 30 to now 50, kind of makes sense. But I think it's a no-brainer. Inflation is coming. It's probably in 2022, late, maybe 2023. It's going to force the Fed's hands. But as investors, if we see demand pull inflation, better employment, higher GDP, more money chasing less things, we can do something about it. And that is learn your market. Buy real estate, 30-year money, even if you have to get something in the 3s, right? A lot of you are going to start complaining to me. I can see the comments already. Oh, Michael, I wish I would have gotten a 2.875 30-year mortgage. Now they're 3 1/8. Shut up. Get the mortgage. Let's go. Rates are on the uptick. And oh, by the way, I've never gotten less than a 6% interest on a 30-year residential mortgage. So relax. You can still do these deals. So that's what I got for you. Again, do your homework. I put out the homework yesterday. If you don't know what I'm talking about, you need some guidance, buy the course, join the Facebook group. Let's go. This is going to be an exciting year. Take care. I've got 3 hours of interviews today. Bye-bye.